You bet. So we need to talk about two things, but like when people know you're on the show, where they're going to want to be talk about two things more than any other. Those two things are gold and silver, obviously. Um, and as we speak here in mid June 2026, gold's down about 20% from the January high, and silver's down about 40% from the January high. And I'm seeing things like I saw a guy today on Twitter put up a little chart, and I think he's tracking like GLD flows or something, and say it's time, it's time to get back in. And I'm wondering about things like I don't know, the announcement of gold backed currency or gold backed crypto or whatever that might come soon. This and personally, I'm kind of buying the dip here on gold, on certain select gold names. I think it's time to get really surgical with that. But what do you think? What do you think about that here as we sit here, 20% down on gold, 40% down on silver?
Honestly, I think that I think that gold and silver have not really broken down as much as they had, as much as it has been shaking people out, flushing out leverage, if you will. The reason I say that is that while the paper price has been pushed lower, the physical market at the highest levels, Dan, is telling a very different story. We've already seen nearly 3 million ounces of gold stand for delivery here in June on the COMEX, which is still only halfway through the month and already over 3 million ounces. Do the math, that's between 12 and 13 billion dollars.
Okay, hold on a second here. Are you telling me that folks have bought COMEX futures and held them and taken delivery?
Correct.
To the tune of 3 million ounces. Wow.
And that's just in the first 2 weeks of the month. There's a difference between taking delivery and leaving COMEX. In the last 30 days, roughly 1 million ounces has got up and left COMEX. And so, there's a difference. Now, you can have it delivered into the COMEX ecosystem. There's two different, there's registered and there's eligible. Registered are the bars that are backing the contracts and that have been rehypothecated. But eligible, we have 9 Brinks vaults in our storage program. They're all with Brinks and throughout North America. One is in New York City. It is the only one of the 9 that is a COMEX depository. So I have, as an example, let's say I have a client who has 1 million ounces of 1,000-ounce silver bars in that Brinks facility. It is a COMEX facility. Those are eligible. They are not for sale. They could be transferred to registered, but they are eligible, and she just leaves them there. So when metal gets delivered to COMEX, doesn't mean it leaves COMEX. Now, it's important to understand, Dan, that I've been doing this for now 36 years, and if we look at the first 34, less than 1% of contracts would ever stand for delivery. In other words, give me the numbered bars, please. I just want the paper settlement. When you see, now this has been going on for 18 straight months. 18 straight months since Trump won the election. Every single month, we have seen billions upon billions upon billions upon billions upon billions delivered, and it has been completely missed by the mainstream. Nothing else matters to me. Everything else is misdirection. Everything else is just noise. When the most well-informed traders on the planet are standing for delivery in ways that we are seeing here, not just here in the United States, which we can talk about, but that is an anomaly in every sense of the word. It is not weakness. It is accumulation under the cover of falling price, which is a tool of misdirection. Sure, pullbacks are very uncomfortable, but they do not change the thesis that gold and silver are real value. They are not someone else's promise to pay, and that's why they matter. You look at China, they've been buying for 19 straight months. They bought 10 tons of gold in May, the largest monthly addition in over 18 months. This follows the 8+ tons they acquired in April. That's making their 19th consecutive monthly net purchase. But we can also talk about silver. I'll give you an example. In December of 2025, COMEX set a single month record with 65 million ounces delivered. In January 2026, 49.4 million ounces delivered, more than 7 times January 2024's level. All of 2025 combined settled 474 million ounces, right? So when you talk about how much more has been delivered recently, let's just look at 2026. In February 2026, 25.1 million ounces were delivered. That was the highest February on record, making it the highest 2-month delivery rate in exchange history. But 39 million ounces in February, about 2.9 million pounds, got up and left COMEX. They got on trucks, $4.5 billion worth got on trucks. Someone ran logistics, someone ran insurance, and drove away. 2.9 million pounds of silver worth $4.5 billion. And where is the mainstream media saying, who the hell is doing this? March 2026, 10,526 contracts deliver. That's 52.63 million ounces standing for delivery. And here we are in June, still early, about 2,200 contracts or so have already delivered. But let's just say from January to May 2026, we've seen 169.3 million ounces of silver physically delivered. And when you talk about that kind of volume, from January to May of this year, we're already 45% above the entire 2023 full year's worth of deliveries in just 5 months. And that's silver. Let's talk about gold for a moment. February of this year was the biggest month ever. 40,711 contracts delivered. That's 4.7 million ounces. June, here we are in June, 33,930 as of yesterday, probably closer to 35,000 contracts. But, you're talking huge volume. January to May, the total comes to 98,720 contracts. That's 9.87 million ounces. That's 45 billion in physical gold in 5 months has been delivered. So my point to you is simply this, and we can look at, like, for example, when the price got its rear end kicked in the first 3 months of the year, China imported more silver in the first 3 months of the year than at any time in the history of the country. And here we just see in February, largest gold and silver deliveries, largest gold delivery, and the 39 million ounces leaving COMEX as the price got its teeth kicked in. In other words, the biggest money in the world is using price as to run cover for physical accumulation. And when I tell you that less than 1% of contracts ever stood for delivery, I'm dead serious on that. And now all of a sudden,
that's what I thought. That's when you started talking about physical delivery, I was like, well, like nobody, it's like you said, 1%. It's nothing. And now, do we know the percentage now?
It's a massive amount. In February, almost all the contracts that posted stood for delivery. I don't know the number, but it is much longer or bigger. And I would just simply say that these people are the most well-informed traders on the planet. And at 9 figures every month for going on over a year and a half, these people don't screw around. And,
this is not speculation. This is accumulation for like long-term, fundamental, strategic type reasons.
Right. And one other thing, you made a comment at the beginning, and you talked about the outflows out of ETFs. And I want people to think for a moment that one possible explanation is that the ETF metal is being tapped as a source of ready available supply. What I mean by that is that when physical demand rises and large quantities stand for delivery, like we've been seeing on COMEX, authorized participants have the ability, and those would be those that fund the baskets like Goldman and JP and Citi and B of A. They can redeem ETF shares very quietly, and they take possession of the underlying metal and they use it to satisfy delivery obligations or replenish inventories or move it to COMEX warehouses or ship it to buyers elsewhere in the world. In that sense, ETFs can become a source of physical supply during periods of tightness. And so when we talk about ETF draining, it isn't always as it seems. In other words, shares were sold off. Well, what if it's Goldman Sachs saying, we want the physical, let's not make the big footprint that we otherwise would on COMEX. Let's just redeem 10,000 shares and stand for delivery. Okay. And they do that all the time.
Okay. So the fundamentals are a lot stronger than just following prices might lead one to believe.
which is the greatest tool of misdirection. I couldn't have said it better myself. That is correct.
Buy the dip is just the upshot here.
Well, and when we talk about the dip for a moment, Dan, you know, the BIS, the most powerful bank in the world, Bank of International Settlements.
Right.
They came out and they almost took the CME group, the COMEX, to the woodshed. I believe most people wouldn't read it that way. I did. And they came out in, I don't know, a month ago, and they said, look, the reason the price fell was because of the actions that the CME took in a stupid way. What do I mean by that? So if we look at silver as a prime example, silver was rising every single week into the end of the year, you know, from December to January, up, 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 up. And as that was happening, they kept raising margins, but not massively, but they kept raising them. And then we get to January. January is notorious for rebalancing of ETFs. And when you have levered ETFs that have gone way out of whack in terms of the percentage gain of the underlying asset, and their prospectus says, hey, come January, all of this needs to be rebalanced. So what happens is that you are guaranteed crazy volatility the first and second week of January. It's notorious for this, as all of that excess has to be sold off to rebalance the ETFs. So what they basically said was, look, into the first and second week of January, as all of these ETFs were being rebalanced, guaranteeing selling, you had the CME group raise margin requirements by 300% at the worst possible time. The worst time, because they were doing it right as things were being rebalanced. Now, to give you an idea what I mean by margin, just to kind of so you understand, your listeners understand,
Right.
We would typically have 2 million ounces of silver in our warehouse. And in order to protect our inventory from price fluctuations, we will sell the exact same amount on COMEX, all the way down to 1 ounce. And so if we have 2 million in inventory, we sell 2 million on COMEX. The price falls by $10 on silver times 2 million ounces. I'm down $20 million in my inventory. But what I sold short on COMEX went up the exact same amount. I'm market neutral. It would cost me typically in December, right? December 1st, it cost me $15,000 in my margin account. That's just, let's just say this bottle of water is $15,000 cash. Just sits in there. Now I can control one 5,000 ounce contract. Or if I'm a speculator, I want to buy a contract, put $15,000 in your margin account, you're good to go. By January 1st, or thereabouts, they had raised it to $54,000. And if you didn't post that extra money, your contract is liquidated. And so they raised margins by 300%. So you have we would have to have $50 million sitting in our margin account just to hedge our position. That doesn't even talk about gold or platinum. And so the margin rates went up so much, along with the rebalancing, where selling begets selling, and the margin calls and selling and more selling, and the price collapsed. And they said, you know what? This price collapse was structural, not fundamental. In other words, it was synthetic and orchestrated largely through ETF rebalancing and massive margin increases at probably the most stupid time.
Right. But Andy, don't in a massive bull run like that,